My colleague Kavita Athaplayal spoke to Devang Shah of Axis Mutual Fund, who shares his insights into the growth story of the debt market and where should investors park their money in this volatile environment. Let's listen in to this interaction.
You covered a lot and probably, as rightly said, that we believe that we are actually nearing the peak of interest rate cycle. Now, can there be a couple of more rate hikes? Yes, possible. Our view is probably April would be the last rate hike when it comes to the RBI MPC policy. But even I think when it comes to global markets and specifically Fed, we don't anticipate anything like where Fed would dramatically go above 5.5 on Fed funds rate. Today, markets are pricing in a 5-quarter, 5.5 kind of Fed future rates across the entire curve, globally also, and probably a large part of Indian bond markets is also pricing in a 6.5 to 6.75 of operative rate. So our view is, yes, we are peaking the interest rate cycle, at least in this rate hike environment. So our view is that with growth slowing, probably trend lower of the CPI, we believe that for most part of this year, yes, RBI can be on pause, but we are nearing the peak of the interest rate cycle with broadly 1 to 10 year across the entire segment now being at 760, 775 levels. The 1 year corporate bond CD levels are at 775, 3 year, 10 year corporate bonds all at 775. And when it comes to the GSEC curve, the GSEC curve between 3 to 5 year or 1 to 10 year, everything is between 730 to 7.5. So the curve being so flat and we not expecting any significant rate cuts in this year, what we're advising clients is to probably stick to the short end of the curve at this point of time. If your investment horizon is less than 12 months, park your money in ultra short-term funds. If your investment horizon is more than 12 months and probably looking at a 2 to 3 year investment horizon, I think short to medium term funds makes a lot of sense. Yes, for the category of investors who are probably targeting long-term investments in fixed income markets, I think long funds also make a lot of sense. Absolute entry levels above 7.5, I think are good to go for investments even which are longer term in nature. So our advice is, first of all, start investing in the fixed income segment and probably depending on investment horizon, choose the bucket of mutual fund category.
All right, Devang, that was very well explained. My next question to you is, why do you think investors should consider almost like 10 years maturity in the current market environment?
So what we believe is, and what I've been explaining is probably if you understand it broadly, the macro is now trending towards where we are peaking on the interest rate cycle. If you look actually across the, I think even if projections from RBI, the growth projections will be lower. I think the best estimate for us is probably the next year GDP numbers will be closer to 5.5 band. If I actually look across at the inflation also, our belief is that the inflation will start trending downwards and will probably have our average inflation for next year closer to 5.5. With positive real rates, I think repo should peak at 675 at max, 6.5, 675. And with overall borrowing number, where we are looking at the fiscal deficit number close to 5.9, a gross borrowing number of close up shade below 16 lakhs and the net borrowing number closer to 11 lakh 85,000 odd crores, we believe so that 7.5 levels are good for investors who are looking at longer term investments in fixed income cycle. So I think absolute entry levels, the curve being flat, for investors who are looking at longer term investment horizon and with a macro, which now we believe that it is a peak of interest rate cycle, I think long bonds makes a lot of sense. What we also like is that if you look across at today, the spreads of government bonds versus SDAs and corporate bonds, the SDAs and corporate bond spreads are too flat because of lack of supply. Government bonds, there has been huge supply and hence the spreads realignment have happened. So we prefer the base curve at this point of time, and 10-year or longer bonds is generally advised for clients whose investment horizon is beyond 5 years. So that's the thought process why we believe that for a certain category of investors, it does make sense at the peak of interest rate cycle to start looking at long bonds.
All right, Devang, this gets me to my next question, which is on the fund launch, Axis Nifty GSEC September 2032 Debt Index Fund. Could you please explain this to us?
Yeah, so it's a 2032 index fund. And as I explained to you that what we believe so, that somewhere down the line, our thought process is very clear. At this point of time, we believe we are nearing the end of rate hike cycle. Secondly, from an investor perspective, I think absolute entry today, 10-year government bonds are trading at close to 7.5. On an annualized perspective, they are trading at close to 760. These are good levels for investors who are looking at a longer term investment solution from fixed income markets. Again, why we have launched a GSEC fund? I think the absolute spreads today of corporate bonds and state development loans, which are generally the other typical investment options available for long term investors, the spreads are too compressed. And hence, we believe that at this point of time, government bonds, index funds makes a lot of sense for category of investors who are trying to find out a longer term fixed income solution, and probably with interest rate cycle peaking, with the inflation trend downward, we believe these funds make a lot of sense for such category of investors.
What kind of investors do you think should be parking money in this?
These should be investors who have a typical longer term fixed income investment solutions and who are targeting more from I think, efficient tax substitutes, who are looking for longer term fixed income investment cycles in India. I think this products makes a lot of sense for such category of investors.
Well, that was Devang Shah for you on where to park your money in this volatile market.